Here's the simplest breakdown and explanation of what happened with the Trump tariffs, why it's introduced so much instability, why things didn't quite pan out the way he thought they would, why there's been pullback and bouncing around and complete volatility in the market because no one really knows what's going to happen next. So here is the best breakdown of what I can give you about what happened and what the results were. And again, these are not only my opinions, these are opinions that have been voiced all over the punditry sphere, but here is what we think. So let's understand that the US has an enormous amount of debt, trillions of dollars of debt, right? When we pay off that debt, we also have to pay off the interest on that debt, right? So what we want is the lowest amount of interest rates, the lowest interest rates we can get in order to have less money to pay to service that debt. Think about it like your credit card. You have a big credit card balance. It's better to have a low interest rate on that credit card than a high interest rate on that credit card, right? Because if it's a higher interest rate, you are paying more over time to pay off your debt ultimately. So how does that apply to the stock market? Well, people invest in the stock market to earn money, and the stock market is volatile, right? So the more volatility that's in the market, the more money that you can potentially make in the market. Conversely, you can lose money as well. So investors put money into the stock market in the hopes that they will earn money over time as the stocks that they own appreciate. Now, that includes a level of risk, and most people are aware of that risk and are accepting of that risk. However, when there is times when there is an extraordinary amount of risk and the stock market maybe is not climbing gradually upward, but is actually actively going down, what typically happens is investors will pull their money out of the stock market. They will sell the positions they have in the stock market. We're talking about the US stock market here. They will sell those positions and they'll take that money and they will reinvest it into US treasuries. Now, what are US treasuries? US treasuries are bonds. What's a bond? A bond is like an IOU that the government gives to people to get their money so they can use that money to pay their debts, right? So the government issues IOUs. Those are called treasury bonds, right? And they come in different lengths of time, 2 years, 3 years, 10 years. And what happens is you give the government your money. Let's say this is a 10-year treasury bill, right? You give the government your money for 10 years. Let's say you give them $1,000, right? There is a price premium on that bond that says the government is going to pay you back that money in 10 years plus interest, right? They've borrowed your money. They're going to use it to pay off their debts. They're also going to give you interest for the privilege of using your money, right? Typically, that's 3%, 4%, right? As those rates go up, the government owes you more money in the long run, right? All right. Typically, U.S. treasuries are seen as very, very safe places to park your money to earn a little bit of return on interest and know you're going to get that money back at the end, right? Because the U.S. government doesn't default on its debts. It's very stable. If you give the U.S. government money with a contract that they're going to pay you back in a certain amount of time, you are going to get that, right? It is a trustworthy, it is a solid, conservative investment. And when the stock market is going crazy, people will take their money out of that very volatile and risk permeated environment and they will stick it in US treasuries, right? Now, US treasuries, how does that interest rate get calculated? Well, when there are a lot of people who want to put their money in US treasuries, the government says, hey, we have a lot of people willing to give us their money. We don't have to pay them that much money in premiums, in that interest, because everyone's willing to give us money. So the premiums, the interest that's being paid, the yield, it's called the yields go down, right? As the yields go down, the money that the US government has to pay back on their loans also goes down, right? It's like figure it as a lower credit card rate. So as treasuries become more and more desirable, the yields go down, which means the government has less money to pay back, right? So we understand that. Stock market, volatile, right? Treasuries, solid. Okay, so the thinking was, and this is not my opinion, this has been out there all over the webosphere for weeks now. The thinking was, if Trump introduced a level of volatility and risk and shook up the stock market, people would freak out a little bit and take their money out of the stock market and park it in US Treasuries. And when there's a lot of people who want to park their money in treasuries, guess what? We already talked about this. The yields go down. The amount of money, the interest rates that the government has to pay back out goes down. That's good for the government, right? So the thinking is Trump introduced a shot of instability and volatility into that market with his across the board tariffs, and people started to freak out, right? So the government's waiting to see all these people take their money out of the stock market. The stock market is plummeting in value, and that money's going to show up in US Treasuries, right? Except that didn't happen. That didn't happen because people took their money out of the stock market when it was going crazy cuckoo bonkers, and instead of parking it in US Treasuries, like everyone thought they would, they took it and they put it in other assets. They went overseas. There was a market uptick in German Bund, the German bonds, right? German government bonds and Japanese government bonds. People took their money and put it in the German markets instead, in the German government and the Japanese government instead of the U.S. government. That is a huge, huge red flag. That means people have lost their confidence in the U.S. government's ability or willingness to pay back their debts. All right. So the old idea of U.S. Government bonds being the stable, rock-solid, conservative investment to get you a little bit of return over time, in this instance, evaporated. It wasn't there. And as the stock market came down, the U.S. Treasuries also came down as well, which meant, here's the kicker, as the desire to get into the treasuries went down, that means the yields had to go up. They had to offer greater and greater interest rates to entice people to put their money into US treasuries. So the exact opposite happened as what they thought and they wanted to have happen. What they wanted to have happen was that the yields would go down, US borrowing costs would go down. Instead, the yields went up, the stock market went down, and we have chaos across the board. That is why less than a week later, you saw Trump put a pause on those tariffs in order to try and get a little bit of stability and positive flow into the stock market, because what was happening wasn't what they predicted to have happen. And what happened was U.S. borrowing rates went up and money went out the door to other governments' bonds. Now, who are the two biggest owners of U.S. treasuries in the world? Yeah, it's the Japanese and the Chinese, right? So those two nations hold, I think the Japanese own about $1 trillion in U.S. treasuries, and the Chinese own like $985 billion in U.S. treasuries. So they own the debt right now. The next bad thing is we've sort of antagonized the Chinese now, right? And the Chinese, if they really wanted to, which they probably don't at this point, but what they could do is they could just sell those treasuries and say, we don't want to have any exposure to the U.S. market anymore because they're doing us dirty. And the flood of those treasuries back into the market would drive down the cost of those bonds, and then the yields would shoot up again because people would have to be enticed to get back into those cheaper bonds. And the system keeps going around and around, and we start circling the drain. So anyway, that is the simplest way I can break it down is the stock market went down. We were anticipating people would flee into treasuries. They did not. The treasury yields went up, which meant U.S. government borrowing costs went up. And the whole thing was a massive play that didn't work the way most people thought it would work, especially those in the government and the Trump administration who thought if we inject some craziness into the stock market, we'll get lower borrowing rates on the other side. Didn't work that way, and the chaos that has ensued for the past couple weeks is still rippling through the market. We don't know where it's going to go, but that's my breakdown, my simplest breakdown of what happened in the last 2 weeks. Don't know what's going to happen next, but stay tuned. Do good things. We'll talk next time.